Okay, I think we will start off and those who join us to afterwards can, well, join us as soon as they join. So hello everybody and welcome to today's webinar where we'll be talking about the difference in taxation between the UK and Spain. So for those considering relocating to Spain from the UK, regardless of where you're moving to from, it's a complicated process, even more so now more than ever. And we're here to help you through that journey. So we're going to give some content today. In addition to today's webinar, we've run further webinars on Spanish residency, visas, property, other details. If you're unsure about where you're looking to move to, we're also covering topics on Portugal and Gibraltar as well. So please visit our YouTube channel. Just search for Fiduciary Wealth there. You can access these and more. So please like, share, and subscribe, because there'll be a lot more content on its way. Which takes me to my next point. Last week, we launched our new podcast series, Money and Finance for Expats, as you can see up there. This is once a week, 10 a.m. UK time, with maybe a few bonus episodes here and there. You can watch us live on YouTube or Facebook, or watch the recordings in these places, or listen to it on Spotify or wherever you tend to access your podcast content. So again, if you subscribe to our YouTube channel, you'll be able to access that weekly, and there'll be a lot of kind of fresh and updated content on there. So today's webinar is about the planning before relocating to Spain and a comparison of the taxation in Spain and the UK. So just to run through the agenda quickly, we'll start by covering the UK side, so the UK exit and the important factor of your UK domicile. Then we will follow up with a comparison of the taxes between the UK and Spain. We will very briefly discuss.
Is it Spain or Portugal?
Spain, yeah.
Spain, okay.
Yeah. Then we'll discuss visas and the tax planning opportunities you have available as an expat. We cover a little bit details about UK pension transfers and the taxation of pension income in Spain, and end with some frequently asked questions, a bit more advice towards the end. We will accept, we're happy to accept questions at the end of this webinar. So please use the Zoom function to submit these throughout, and we'll answer those towards the end. So before we kick off, I will just make a quick introduction for those who haven't spoken to us before here at Fiduciary Wealth. So my name is Matt Penfold, advisor and director here at Fiduciary Wealth. I've been in financial services for 20 years and spent the last 4 years working here in Gibraltar, but living across the border in Spain, having myself relocated from the UK. And also we have here Paul Correa. Paul is managing director and co-founder of Fiduciary Wealth Management. Paul has extensive years of experience in financial services, a strong private banking background, and extensive wealth management background. And in 2007, he co-founded Fiduciary Wealth, partnering with Islas 1892, the oldest law firm in Gibraltar. And aside from our legal roots, Fiduciary Wealth is a member of MGI Worldwide, a top 20 global network of accountants, tax advisors, and companies. And our aim is to give an impartial, quality advice to those, mainly focusing on UK, Spain, Portugal, and Gibraltar, but we can cover the whole of Europe. But for today, we'll be focusing on Spain. So, Paul, if I can hand over to you and you discuss the UK side, how it's important to plan our exit properly, please.
Yeah. Thank you for the introduction, Matt. And yes, planning the exit is just as important as planning the arrival to your new country of residence, in this case, Spain. I think there are many factors that one needs to consider or which determines whether you are deemed UK tax resident or not. And the number of days that you spend physically in the UK during the tax year is clearly an important consideration, but not the only one. You also need to think about your pattern of presence and your connections to the UK, which can include everything from family, property, your working life, and any social connections that you may have. It is the UK Statutory Residency Test 2013, which allows you to plan the date in which you become non-UK resident and determines how much time you can still spend in the UK without re-triggering residency. So effectively, the exit, and based on the number of ties that you retain, how many days you can spend after having exited in the UK without being challenged and considered that you've never left in the first place. So it's always desirable to exit at the end of the UK tax year, which is on the 5th of April, only because it's cleaner. So it's a better way of doing it. However, you are allowed to split the tax year between the UK and Spain. In other words, to apply for what they call as the split tax year rules. And there's some specific situations where split year rules apply automatically without the need for any guidance whatsoever, or having to refer the matter to HMRC or being questioned further down the line. And the 3 instances where split year rules apply are when you have obtained employment overseas. Secondly, when your spouse or partner has secured employment overseas. Or the 3rd instance is when you sell your main UK residence. So ideally, you exit the UK at the end of the UK tax year because it's cleaner. Failing that, you can apply for split year rules. And there's the specific guidance I've just outlined where split year rules apply without any question or doubt. And of course, you can go for option 3, which is a haphazard way of exiting the UK, and you risk being challenged, and there would be tax consequences. But the exiting the UK is just, as I mentioned earlier, is critical, and just as important as the arrival process in Spain.
Okay, great, Paul. And we talk about exit in the UK, and so somebody's cleanly exited the UK. They're now living in Spain, and then think, okay, I only have to worry about taxation in Spain. But that's not the case with everything. And one important thing is your UK domicile and how that links to inheritance tax, Paul.
Yeah, well, the first thing I would like to say is that, as you know, Matt, the Spanish succession tax is based on the concept of tax residency, not on domicile, because all Napoleonic law countries, Spain, Portugal, Italy, France, they base succession tax or inheritance tax on your tax residency, whereas UK base it on another concept, which is domicile. So because Spain has a very complex tax rules, and each autonomous region can apply its own rules concerning succession tax and indeed wealth tax for that matter, Matt. Then I think it's outside the scope of this webinar to go into each and every one of the regions. But if you take Andalusia, for instance, I think there's an exemption of up to, is that $1 million? And then anything in excess of $1 million is taxed at 1.
Correct,
between direct descendants and
absolutely,
and family. So I think, unless you have a substantial estate, I think and if you move to Andalusia, then clearly the tax consequences are now fairly negligible. So one has to look at it from, well, there's another point as well, that even though there's a double taxation treaty between the UK and Spain, it covers capital gains, it covers income, etc., etc. But it remains silent on the issue of inheritance tax. So because it's not captured by the double taxation treaty, and because they operate on different systems, one on taxes, inheritance on residency, and the other one on the principle of domicile, you could find yourself between a rock and a hard place with liabilities on both ends, and with no guarantee that you've got the right of set off, and it becomes complex and painful, right? But that's a side issue. In terms of, you're right, in terms of being liable to, or potentially liable to UK inheritance tax, it's based on the concept of domicile of origin. This is something you acquire at birth, normally from your father. So if you were born in the UK and your father was born in the UK, I mean, it'd be hard to argue that you're not UK domiciled for IHT purposes. And whilst you can claim and acquire a domicile of choice by settling in a country with the intention of staying there permanently, it's fraught with difficulty. There's no fixed rules. The burden of proof always falls on you to prove that you have successfully acquired this domicile of origin. So in our experience, you know, it's a tricky one, and let's not forget, Matt, that from past experience, and we see it all the time. You know, every single year we've got some of our clients going back to the UK for one reason or another. Normally because of ill health. We've had one recently, unfortunately, and they go because they want to be treated by the NHS rather than, you know, in a foreign country. They feel more secure, but equally it could be the passing of a spouse, where they no longer have any support network in Spain, and they want to go back home. Even if it's on a temporary basis because of temporary ill health, you know, 1 year of tax residency in the UK will retrigger UK domicile. So even if you were to successfully shed your UK domicile, something which is not easy to do anyhow, you know, going back for a year is enough for HMRC to argue that yeah, you've been UK domiciled all along. Of course, if you look at the textbooks, it says that after 5 complete years of non-UK tax residency, you shed your UK domicile. But look, in practice, it's more complicated than that. And any ties that you may have, whether it's business interests, social connections, family interests, property ownership, or even your intentions, which is the all-encompassing clause, can bring you back into the fold and make you UK domiciled. And in the past, you know, any insignificant ties tend to be challenged by HMRC. They will rely on the most tenuous of grounds to dismiss claims that one has acquired a domicile of choice. The most high-profile case, Matt, is the late Welsh actor Richard Burton. He lived for many years in the US. He then subsequently moved to Switzerland in 1957. He passed away in 1984. He spent 27 years in Switzerland, let alone the time he spent in the US. He had PACA advice in the UK to avoid any liability to UK inheritance tax. But the UK tax authorities made a successful claim on his estate on the grounds that he never relinquished his UK domicile. And they relied on, you know, despite having been outside the UK for more than 30 years. And the claim was successful on the grounds that he purchased a burial plot in Wales, and he had retained his emotional ties to the mother country, and he never intended to leave the UK. And they also say that whether this is just myth or reality, who knows, is that the fact he was buried in, you know, in the Welsh colours, in the Red Dragon, and holding a copy of Dylan Thomas poems certainly did not help the late actor's cause. As a result of all this, his estate of 5 million was taxed, and they were subjected to a IHT bill of 2.4 million, which was a lot of money in 1984, right? So the only good thing, everything has a polar opposites, and the only good thing to say to this is that when you become non-UK tax resident as an expert, it does open up tax planning opportunities that if which you exploit by restructuring your financial affairs in a better way, can either mitigate or potentially eradicate IHT completely. Again, with a caveat that not every case is the same, and whether it can be partially mitigated or fully depends on the individual's personal circumstances.
Perfect. Thanks, Paul. So no, very much the case with inheritance tax is it can be complicated, especially if you're an expat, because there's two sides, and it's, as with everything, but especially so here, planning is so key. And better to be planned rather than kind of regret it. And also we have to bear in mind that we say it, and if there is a claim on your estate, you're not going to be there to defend yourself, and it's your beneficiaries who will have to deal with that and have that pain. So okay, we'll move on, and we will do a quick comparison of the taxation in the two jurisdictions. Now, bear in mind, I'm sure most watching this are from the UK, and we won't bore you with the UK taxes too much, because I'm sure you're very familiar with those. And then with Spanish taxation, there's a couple of things to take into account. Look, we're here to provide information. Taxation is complicated, and each individual case is different. So use this information as a guide, and if you're serious about relocating, have a more in-depth one-to-one conversation with us. The second point, and Paul, it's something you mentioned earlier, taxation in Spain can be even more complicated because it can be set by the region. Using the example with inheritance tax is very generous in Andalusia in the south, whereas less so generous in other areas. And then we have things like income tax, which is actually a combination of the regional and the annual taxation. So it can be complicated. When we're looking at some numbers today, we will use Andalusia as an example. It's an expat destination that many of you may be looking at. So we've covered inheritance tax and succession tax in Spain, and as Paul says, if you pass if your beneficiaries are direct descendants, this class is your parents, grandparents, children, grandchildren, your spouse. In Andalusia, there's very little succession tax, just 1% over your first 1 mil. I think one important factor in there that sometimes is worth considering is that this exemption doesn't apply to stepchildren. So again, you need to kind of plan carefully with that. And if you don't have the exemption, it can be high, up to 36.5%. So similar to the 40% we see in the UK. Now, when it comes to income tax, I'd say Spain is roughly kind of comparable with the UK. In Andalusia, the taxes range from 18.5 to 46.2. Works similar to the UK in the sense that the more you earn, the higher the tax rate. But there's a much greater range of bands in Spain, and part of that is this combination of the regional and the national taxation that they use. There's also a basic allowance in Spain, but it's much lower than the UK. It starts at just over €5,500. It does increase slightly when you reach 65, increases slightly again once you reach 75, up to around kind of 8,100. We move on to capital gains tax. So as you know, in the UK, this is 18 or 28%. We see something fairly similar in Spain. It ranges based on the amount of gain that you are making in that year, ranges between 19 and 26%. I guess a big difference is in Spain, you don't have the capital gains allowance that you do in the UK. And although this is going to reduce in the UK, there will still be a certain limit, whereas we don't have that in Spain. We also have the issue for expats in Spain is that you might be used to certain investment structures, such as an ISA in the UK, which protects those investments from capital gains. Once you leave or exit the UK, then the ISA tax benefits are no longer valid. So it's very important to plan properly against capital gains in Spain. And we will kind of cover a few of the options that you have against that a little bit later. Another thing to kind of quickly touch on when we're talking about capital gains is when you're selling your UK home. And you need to be very careful that if you are selling your UK home after you become a Spanish tax resident, then you could be liable for tax on the gain then. So it's always advisable to look at selling your UK home or homes before you become a Spanish tax resident. We move on to dividends. In Spain, nice and simple, these are taxed as the same rates as capital gains, so between 19 and 26%. VAT, we will cover briefly, not too much difference, 21% in Spain and 20% in UK. And I think the other taxation to cover, and Paul again mentioned this earlier, is wealth tax. So wealth tax is something that we're not used to in the UK, and they have in Spain. But again, this is complicated, and at the moment, there's a bit of a change happening. So to use Andalusia as an example, wealth tax is set by the regional governments. So earlier this year, I think a couple of months ago, Paul, they came out and said, okay, we're going to remove wealth tax. We've done the calculations, and the amount that we bring in actually is, we're losing out because it's putting people off relocating to the region. But only a couple of weeks later, the national government, which is a right-wing government compared to the no, sorry, it's a left-wing government compared to the regional right-wing government. They introduced a second wealth tax that would supersede this. Now, it hasn't been signed off yet, and that's to come in 2023. But wealth tax is something that is important to be aware of. Again, depends on the region, depends what happens with this new wealth tax, depends what assets you are holding as well. So again, that's something to bear in mind, and that we can have a conversation with you at a later date. So we move on to the next part, and we'll cover very, very briefly the visas to gain residency. So, focused on Brits. So post-Brexit here now, unless you have an EU passport or a spouse who already has one, you will need a visa to gain residency in Spain. Now, we won't go into too much detail here. We've done a webinar previously that covered this with a lot more information. So if you want more information on the visas, visit our YouTube channel when it's there ready for you. So very briefly, if you are retired, you need to look towards the non-lucrative visa. For those who want flexibility to come and go as they please, you may not necessarily want to become tax resident. That would be dependent on the time you spend in the country, but you may want access to the Schengen area and free movement throughout the EU. You could look at the golden visa, which would involve an investment of minimum €500,000 in Spain. For those still working, your options are limited. If you've got the funds, you could apply for the golden visa and you can work. If you have the non-lucrative visa, you cannot work on that visa. Your other options is to be sponsored by a Spanish employer. You can set up a business in Spain, but it has to be a kind of tech-driven, innovative business that could qualify for the entrepreneur's visa. And then the final point is, and I see people asking this a lot, is there's been talk of a digital nomad visa and that this will come in 2023. Now, who knows if that will come and in what form it will come. We're talking about Spanish bureaucracy here, so that will move pretty slow, and it already has. So at the moment, we can't really comment too much about what that will entail, but there's bound to be conditions that would need to be met. There'll be conditions for you to qualify that. I believe there will be minimum income requirements to qualify for that. But as we stand, it's not available. So for the nomad visas, it's a case of watch this space. So moving on for that, and we talk about tax mitigation and succession planning. So tax in Spain is, if we look at it generally, it's of a similar level to the UK. You have places like Portugal, where you have the NHR, which is a very tax-friendly scheme. You have Gibraltar, which is very tax-friendly for expats. Spain doesn't really offer that. So it's important that if you are keen to move to Spain, that you plan and take advantage of those opportunities that are available for expats that Paul mentioned earlier. So we will cover these kind of quickly and briefly again, and a few of the options that are available. So you have the option of transferring your UK pensions to a QROPS. Generally, we would advise to use one in Malta because Malta has a double taxation agreement with Spain. And there's a few reasons for this, which I will just kind of list off rather than go into detail. The death benefits from a QROPS can be much more beneficial than a UK pension. It is possible for income to be drawn at a much more preferential rate, which Paul will touch on a little bit later. And the lifetime allowance is an important one. So for those of you close to breaching the UK lifetime allowance, which is a limit on the amount we can hold in pensions without paying a costly tax on that, or even for those who have already breached that limit, if you transfer your UK pension to an overseas QROPS, then the amount you have in pensions, it's tested at that point. It's called a benefit crystallization event. You will have to have one on your pensions at some point, so the sooner the better. Once that test happens, if you are under the limit, then your pensions can continue to grow way above the limit, no further test, no further taxation. Likewise, if you're just marginally over the limit or even quite substantially over the limit, better to transfer now. Okay, you have to pay that tax, but you will have to at some point, and then your pensions can continue to grow. So we can explain more about that in more detail in a one-to-one conversation, or we have that information on our previous webinar, but there's a lot of positives and a lot of good reasons to use an offshore pension, a QROPS. The other options you have is similar to a QROPS, is a QNUPS. So a QNUPS, like a QROPS, is a pension, but the big difference is a QNUPS is funded via the investment of a lump sum, whereas a QROPS is the transfer from your UK pension. So you invest money into a QNUPS and it has the same benefits as a QROPS. You can absolutely draw the income at a preferential tax rate, single figures. The death benefits are very generous. There's no capital gains on the amount that you invest in the QNUPS because it's a pension structure. And importantly, because it is a pension structure, any investment you make into a QNUPS is immediately outside of your estate for UK inheritance tax, even if you were to return to the UK in future. So we talked about an expat's continued exposure to UK IHT, and a QNUPS is a very useful tool to plan against this. Now, it has to be set up as a genuine retirement scheme. What we mean by that is the funding has to be in line with your age, wealth, income requirements. So to give an example, if you've got a net wealth of 5 million and you come to us age 75 and say, okay, I want to open a QNUPS, I want to put 4 million in the QNUPS. That won't work. That's an IHT fudge. So with a QNUPS, the most important is that we can measure the investment for you, make sure that it's the correct amount. We can, but also that you take advantage of that opportunity earlier. The earlier you can do, the more that you can fund it, the more tax you can save. And then the final one I want to cover today is a Spanish compliant investment bond, which you may have heard of before or may not have. And in Spain, for expats, is really the closest alternative we have to the ISA. As mentioned before, you exit the UK and the ISA tax benefits no longer exist. So you will pay annual capital gains tax on the growth in those investments. If you build your investment portfolio within the Spanish compliant bond, then it can grow free of capital gains. There's no taxation until you make a withdrawal from that bond. And then when you do make that withdrawal, only the gain element is taxed. As part of this, the bond provider can actually calculate that gain, and they will pay this to Hacienda, the Spanish tax authorities, before paying the income to you. So you don't need to declare that. There's that kind of administration that you don't need to know. So you don't need to do. And then because you're taking that withdrawal, you take that withdrawal, only a small element of that will be classed as a gain. So your tax liability will be relatively small. So it's a very tax efficient. You will pay a small amount of tax when you make the withdrawals, but it's really the most useful equivalent product for expats here in Spain. So the QNUPs and the Spanish compliant bond, they both have their uses. They both have their pros and cons, and there is no one fits all situation for anyone, which is why we say we need to have a conversation with you. You know, investment planning, wealth management should be done on an individual tailored basis. So if you are relocating to Spain, reach out to us and we can discuss those options with you. So Paul, I'll pass back to you, and I mentioned about the QUPs and UK pension transfers. So if you can tell us a little bit about the tax treatment of those and how those are being dealt with at the moment.
Yeah, well, there's two things which are governing or influencing UK pension transfers. One of them is the new UK pension transfer regulations, which were introduced exactly a year ago in November 2021. And it's the UK Pension Schemes Act 2021, which enables UK pension seeding scheme trustees to refuse to effect a UK pension transfer when they perceive that there's an increased risk of pension scamming. It's becoming increasingly difficult to get UK pensions transferred across to a suitable overseas pension scheme, which would, without a shadow of a doubt, improve one's tax efficiency. So processing times are getting much longer. There's more due diligence to satisfy. And at the end of the process is not so much about avoiding pension scamming, but about the UK pension industry trying to slow down the process. And there's good reason for it. One, you know, besides pension scamming, and no one can honestly say that it hasn't happened in the past. But I think the rules have been tightened to the point that that is the rare exception. But I think, and this is a personal opinion I'm expressing here, that it's more to do with the fact that when people are in the UK and they're getting tax relief on pension contributions, the UK Exchequer loses out on tax revenues, right? And then at the end of the process, when they reach retirement and they're going to draw down pension, and it's time for the UK Exchequer to get their hands on a bit of tax, that's when people move abroad, right? And there's no tax for the UK Exchequer. So both the UK government and the UK pension industry, because it's losing pension assets to overseas schemes, have a vested interest in making the process as cumbersome as it possibly can. So yes, on the one hand, it's pension scamming, but the evidence that we see in front of us suggests that you know, the process is being slowed down for no particular good reason. And even when you satisfy all the due diligence, that they make it as complex and as awkward as they possibly can. So if someone is planning to exit the UK and move to Spain, and they have to draw on pension income, they should not assume that they exit the UK, they land in Spain, they touch a button, and there comes the pension payment every month, because the delays are can be as much as a year. And even in some cases, Matt, as you know, it's been more than a year.
Oh, yeah.
And we're trying now to streamline our own internal process to see if we can push it through. So I think that one piece of advice I would give is to plan early the UK pension transfer, because, you know, if you look at the spirit of the regulations for qualifying recognized overseas pension schemes, it allows you to start the process 12 months before you actually exit. And I think the best advice is you do. You start the process early while you're still UK tax resident, provided, of course, that the intention is to exit the UK. And then the other area which is of concern, so to speak, is the overseas transfer charge, which is something that the UK government introduced in 2017, and effectively imposed a 25% tax charge for UK pension transfers to third countries outside the EU and the EEA. And the reason why they didn't extend it to the European Union for pension transfers, say from UK to Spain, is that the UK was a member country of the European Union and therefore subject to the 4 freedoms. One of those freedoms is the free movement of capital. So under the 4 freedoms, pensions were allowed to be transferred across the EU without hindrance and without any tax imposition. But I think now that the post-Brexit reality is that there's a risk that the UK government, if there's any tensions or further tensions with the European Union, thankfully things have quietened down in the past few months. But if things, if the relationship deteriorates for whatever reason, they can now legitimately extend the overseas transfer charge for UK pension transfers from the UK to the EU, which would have, of course, massive implications for UK nationals still leaving UK shores for Spain. So I think that's one to consider. So given that the window might close, and we're not saying it will, we're just saying there's a strong probability it might sometime in the future. I think, the best advice is not to leave it too late. And then in terms of, and I guess that was the main thrust of the question that you asked, Matt, about taxation of pension income.
Yeah.
In Spain, the amount of tax you pay on pension drawdown depends on whether the pension contributions, not entirely, but to a certain extent, whether the pension contributions were which fund the qualifying recognized overseas pension scheme, Europe's, suffered personal tax in the UK, or were in effect a benefit in kind from the employer. In other words, an employer contribution. Because if you pay tax on your earnings, and then out of your net salary you made employee contributions to a scheme, you've suffered tax, and it is treated more favorably in Spain. Those contributions are treated more favorably in Spain. However, as I said, employer contributions, the tax treatment in Spain is completely different to that of the UK, and they perceive that to be a benefit in kind which has never been taxed. And hence why that taxation in Spain of pension income is more complicated than it is back home in the UK. So for contributions by the employee made from net salary, you can structure these as short-term temporary annuities, and the tax you pay will be roughly between 2% and 6%, depending on the level of pension drawdown, how the pension is structured, whether it's structured as an annuity, short-term annuity or not, and progressive tax rates in the autonomous region in Spain where you live. As you know, there's nuances between autonomous regions when it comes to personal tax. Even if they are minor, but nonetheless, there's marginal differences. So those are the things that condition the actual tax you pay. There's also another development. Quite recently, the rules have been changed again in Spain in terms of short-term annuities. And whereas in the past, you could renew a short-term annuity, temporary annuity, the advice we're getting is that you can no longer continually renew short-term annuities. So the advice that we now give is that you should fix an annuity for 30 years. Whether you live 30 years or not is completely irrelevant, and that you don't break it. That requires that you look ahead and you start thinking long-term. What is the maximum pension drawdown that I would likely make? Not today, not tomorrow, but maybe even 10, 15 years from now. And you have to take into account variables like inflation and tax rates and your income requirements, how they evolve and change as you age. And you have to kind of have this crystal ball and look ahead and look forward and factor those things into account, and then decide, okay, I think that in year 20, this might be my income requirements, and I'm just going to fix this annuity for 30 years. It's not helpful. I accept that, but it's the only way of having an annuity which will be tax favorably for life. Of course, if you live more than 30 years and you move to Spain age 60, well, at age 91, you're paying at the marginal rate. Who cares? Yeah, at that age, at least you've enjoyed your lifestyle in retirement in the sunshine years, or whatever you call it, in the best years of your life. And the other thing is, if your contributions have been, I think I've said that if the contributions are paid by the employer, then you pay tax at the marginal rate, which is based on a progressive tax system. And then there is the blended approach. Yeah, you in the UK, you combine and consolidate a number of pensions, some of which are employer contributions, some of it is employee contributions, and it's a mixed bag. And you consolidate it under one scheme, and then it's very difficult to open the bonnet and for the tax authorities in Spain to determine the sources. And remember, it's not just the contributions, but the growth that has in those pension funds over one's working life. And then the tax treatment is very difficult to foresee, because it depends on the tax advisors how they advise the individual to submit their tax returns, and it depends on the tax authorities in Spain how diligent they are and how detailed they want to be. So that's a bit more grey, Matt, I would say.
Yeah, no, I think really grey is a good summary of Spanish taxation in general. Anyway, it's I think taxation in the UK is a little bit more kind of black and white, but maybe kind of less so in Spain. But it's a complicated process, and I repeat myself, but yeah, it depends on your individual circumstances, depends on your funding of your pension, and a few other factors as well. So perfect. So Paul, we're reaching to the end, but I think you've got a couple of frequently asked questions, but questions that people ask us quite often.
Well, I'm going to be gentle with you, Matt. I'm only going to ask you two.
That's very kind, because you're a nice guy.
I'm a good mood this afternoon, yeah?
Yeah.
So my first question, can I move to Spain but elect to pay my tax in the UK?
Okay, yeah. I mean, that is a question we get quite a lot, maybe even more so after a webinar like this, because people think, oh, taxation in Spain is complicated. I want to live there and enjoy the lifestyle, but I don't really want to be in the tax system. But the answer is no. If you're a full-time resident in Spain, so you live here more than 183 days, then your tax obligations are in Spain. You have to do an annual declaration and you have to pay the required tax in here. So very straightforward answer to that one, Paul. No, you can't.
You can't. And then I have my final question. What about UK state pension? How's this taxed and treated in Spain?
Okay, good question. So if you relocate from the UK, you should really be notifying the UK authorities that you've exited the UK, and if you do that properly, then your UK state pension will be paid gross in the UK, and then you add this as part of your annual declaration in Spain, and you pay tax in Spain on this. Part of we talked about the double taxation agreements, and which of course exists between Spain and the UK, and part of that means that even if you are receiving your state pension while you're resident in Spain, you continue to get the uplift that you would in the UK. So the triple lock, when it applies, there are a few countries worldwide that agreement isn't in place, and really, once they start taking your pension, your state pension, it doesn't have that annual uplift. Therefore, you're effectively losing money every year, but not a problem once you're in Spain. So, Paul, you was gentle to me, so I will be gentle back. So, just one question for you, and a very straightforward one. So, we have people here, they're considering relocating to Spain. What is one piece of advice that you think they should follow?
Okay, you know that my answers are rarely succinct.
Of course.
But I'll try my best to be short and sweet. So I think firstly, to start with the problem, that there's a lot of information in the World Wide Web, and some of that information is completely out of date or simply inaccurate. And you cannot rely on general information to make specific personal decisions. That is a big mistake. And the danger, of course, is that you try and piece everything together in your own mind in terms of what it all means, and then you arrive at a conclusion which is completely erroneous. And the danger is that by trying to be penny wise, you end up being pound foolish, and it can be a very, very expensive mistake, because these things is not something that you can somehow map out based on information you have in the internet. You will definitely get it wrong, Matt, as we both know. And then coming to an advisor to undo the damage is a damage limitation. The damage has been done. So the reality is, when you move from one country to another, it's a very bumpy road. You really need to have an advisor by your side that you can trust. I understand there's trust issues when you leave the UK and you've been in good hands with an advisor you build a personal relationship with. So there's emotional ties, and the trust credit account is high because they've been good to you. But once you move to a third country, they're no longer authorized to give advice, and they don't understand the nuances and the differences in the tax between the UK and the Spanish tax regime. So you need someone on your side who can make the journey easier, ensure it's a smooth and seamless transition to Spain, avoid the common pitfalls, identify areas where you can save tax. And as anything else in life, failing to plan is planning to fail. And you do need a timeline that you follow diligently. You need a clear strategy, and you need someone by your side that can help you ensure that you execute it in the right way, and you don't miss a key step that proves to be very costly. But there's so many different things to consider when you're leaving UK for Spain. It's pension consolidation. You touched upon lifetime allowance limits. If you're close to or about to exceed the lifetime allowance limits, when you should do that. How do you dispose of your UK main residence, when, and how to make use of the exemptions. Trying to time the sale of your main residence to avoid UK CGT completely. I mean, that's a massive, potentially could save a lot of money, depending, of course, on the value of the property. And of course, restructuring your assets to make them tax efficient from a UK perspective for IHT, but equally in terms of the income that you draw in Spain. So it's all that piece of relocating to a country and making sure that you are taken care of by someone you build rapport and you can trust, and they know they're looking after your interests rather than their interests.
Wonderful. Thank you, Paul. Firstly, a very good answer, but short and sweet. I'm not sure about short and sweet. Well, I'll let someone else just decide that. I think I'm a bit biased.
My track record is not very good. So.
Well, yeah, at least you're consistent. That's what I appreciate.
Absolutely.
Yeah, good. Wonderful. So we've reached the end of the webinar, and there are no questions from those joining us, Paul. So that's it. No more of your super short answers for us. So firstly, we're grateful for those who've either joined us or are watching this on YouTube. What we would say is there's a lot more content on our YouTube channel. So if you could like, share, or subscribe, either do that so you have access to all that free content, or if you just want to do that as your sign of gratitude for this free webinar and the others that we are delivering. But yeah, go to our YouTube and you know, we'll be doing our weekly podcast, which I'm sure will add a lot of value for people. So feel free to subscribe to those. So yeah, other than that, thank you so much for everyone to join us, and hopefully we'll speak to some of you soon. Bye-bye.
Thank you. Bye-bye.